Welcome back to New Venture Mentor, your source for straightforward advice to help you plan, launch, and grow your new startup or small business. I'm Kate Costa, and today I want to talk about the difference between top-down and bottom-up calculations in business planning. When I meet with clients, much of our time is spent around crafting a business plan that sets the business owner up for success, whether they're going after outside funding or the plan will remain an internal strategy document. And one of the things that nearly every entrepreneur that I've ever worked with misses is bottom-up calculations. Now, many of you are probably shaking your heads in confusion, so let me explain. Top-down calculations for a company figuring out potential annual revenues look something like this. The total US market for widgets is $20 billion. So if we just get 1/2% of the market, we'll be a $100 million revenue company. They're called top-down because you're starting at the top, the high level, the whole market, and you're working your way down to your overall business. The trouble with this is that it has no strategy attached to it whatsoever. Cool, you can do math to figure out that 1/2% of $20 billion is a lot of money still. But it doesn't mean anything for your business. I could say if I just managed to get 1/2% of Ben & Jerry's sellers to give me a free pint of ice cream, I'd be eating Ben & Jerry's for a year at no cost. But I probably don't need to run out and buy any extra freezer space to house all of my delicious Ben & Jerry's because I have no plan for making that happen. In a business plan, it's the how that we need to focus on to produce the what, not the what itself. If you have no how, you just have a top-down calculation and you're giving yourself away as being naive about how challenging it is to acquire a customer, and you're making yourself look unsophisticated. So that brings us to bottom-up calculations, which will give you a more accurate prediction of the future of your business if you do them right. Now, in contrast to top-down, which started at the high level and moved down to the business, bottom-up starts at the individual sale and moves up to the overall business. So, for example, if you're going to use AdWords as one of your marketing paths, you might say, okay, I'm going to run ads with ABC keyword, which has an average cost per click of X, an average click-through rate of Y, an average conversion rate of Z for an average sale of LMNOP dollars, and then you build up from the cost to acquire one customer to the total projected revenue for the business. You can see that the bottom-up calculation is inseparable from the plan for how you will achieve that final revenue number. So it's a more useful method of estimating. If you notice that you have revenues in your pro forma income statement that are not directly accounted for with a marketing expense, you're probably not using bottom-up, and you likely want to take another look and see what you're basing your revenue predictions on. That's it for this week. If you liked this video, please let me know with a thumbs up and a share, and don't forget to subscribe so you never miss the latest tips and info to help you plan, launch, and grow your new startup or small business. Thanks for watching, and we'll see you next time on New Venture Mentor.